Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about BEONE Medicines LTD quarterly report. BEONE Medicines AG offers a diverse range of businesses and services in the oncology sector. The company's commercial stage products include BRUKINSA, a treatment for various blood cancers, TEVIMBRA, an immunotherapy for solid tumor and blood cancers, PARTRUVIX, a treatment for various solid tumors. Its clinical stage products comprise small molecule inhibitors, including BGB-11417, BGB-16673, and others targeting specific cancer-related enzymes and proteins. Antibody-based treatments, such as osiperlimab, BGB-A1217, zanidatamab, and BGCone 137. The company also has various preclinical programs in development. Additionally, BEONE Medicines AG collaborates with several partners through agreements with Amgen, BMS, Biothera, EUSA Pharma, Louis Pharmaceutical, and Novartis. The significant increase in BEONE Medicines Ltd's stock price over the past year can be attributed to several key factors. The company's exceptional Q3 2025 financial results, which exceeded analyst expectations, played a major role. Robust sales of its oncology drugs, particularly BRUKINSA, contributed significantly to this growth. Additionally, favorable regulatory developments, such as the European Commission's approval of TEVIMBRA and the U.S. FDA's breakthrough therapy designation for sonrotoclax, further boosted investor confidence. A strategic royalty deal with Royalty Pharma worth $950 million also had a substantial impact on the stock price. This influx of capital, combined with the company's strong financial performance and upgraded revenue guidance, has led to a remarkable 62.57% increase in the stock over the past 12 months. Analysts maintain a strong buy consensus rating for BEONE Medicines AG, indicating continued optimism about the company's future prospects. The primary drivers of revenue growth or decline for a pharmaceutical company are multifaceted and influenced by various internal and external factors. On one hand, successful commercialization of key products, effective distribution channels, strategic collaborations, regulatory approvals, and efficient manufacturing and supply chains contribute to revenue growth. Conversely, failure to maintain an effective distribution channel, interruptions in medicine distribution due to price controls or other factors, delays or termination of clinical trials, reduction in reimbursement from government programs, and implementation of cost containment measures can lead to revenue decline. Additionally, external factors such as changes in laws and regulations, compliance costs, potential loss of business due to reputation damage, climate change, product liability claims, tax-related uncertainties, market fluctuations, and general economic conditions also play a significant role in shaping the company's revenue trajectory. By understanding these drivers, pharmaceutical companies can proactively develop strategies to mitigate risks and capitalize on opportunities for growth. Net income experienced a significant turnaround between 2024 and 2025, shifting from a loss of $492,905 to a gain of $220,431. This improvement can be attributed to increased operating cash flow by $926,024, reduced net cash used in investing activities by $216,925, and enhanced net cash provided by financing activities by $764,548. Profit margins also saw a notable increase during this period. Gross profit margin rose from 84.2% in 2024 to 86.3% in 2025, while operating profit margin improved from -18.3% to 6.8%. These changes can be attributed to revenue growth, improved operating leverage, and reduced expenses as a percentage of product sales. The decrease in selling, general, and administrative expenses as a percentage of product sales from 49.8% in 2024 to 40.1% in 2025 was a significant contributor to the improvement in profit margins. This reduction in expenses allowed for increased profitability despite relatively stable revenue growth. The company has made a significant improvement in its operating cash flow. In contrast to the prior year's negative operating cash flow of $215,791, the current year has seen a substantial increase with an operating cash flow of $710,233. This indicates that the company is now generating positive operating cash flow, suggesting improved financial health and stability. The company's debt level and interest expenses have undergone significant changes over the past period. In terms of debt levels, there has been an overall decrease in total debt from $1,018,013 to $952,867. However, current portion of debt has increased significantly from $9,312 to $52,245, while non-current portion has also seen a substantial increase from $2,025 to $832,755. Interest expenses have also fluctuated, with some periods showing decreases and others showing increases. Notably, interest expense paid decreased from $38,162 to $36,148 in one period, but increased to $5,580 in another. Additionally, net losses on fair value adjustment of convertible notes have been reported, ranging from $1,664 to $3,093. The introduction of a new facility and changes in interest rates have also impacted the company's debt level and interest expenses. Overall, while there are some inconsistencies in the data, it appears that the company's debt levels have decreased, but with significant increases in certain areas, such as current portion of debt. Interest expenses have fluctuated, but overall remain relatively stable. The financial performance of BEONE varied across regions in the given period. The standout performer was China, where sales were successful under a government contract on page 53. However, this success was short-lived as the region faced challenges due to loss of normal trade status and potential tariffs on page 54. In contrast, the U.S. performed poorly due to uncertain reimbursement rates and downward pressure on prices on page 52. Europe also struggled with VIDAZA not winning a bid, leading to a decline in sales revenue and restricted use in public hospitals on page 53. Other countries including Canada, Mexico, EU, and others were impacted by U.S.-imposed tariffs on page 54. China's performance was mixed, with reduced prices for included medicines potentially offsetting increased demand on page 52. Management is expressing concern over the company's outlook and strategy due to significant regulatory risks in China. The company faces challenges from changing laws, regulations, and interpretations that can increase compliance costs and potentially impact business operations and financial condition. Management is aware of the need for regulatory approvals and permits to pursue growth strategies, including acquisitions, but notes potential delays or inhibition due to required approval processes. Overall, the company's strategy is heavily influenced by regulatory risks, which may have a material adverse effect on its business, financial condition, and results of operations. Acquisitions and divestitures overview. The financial summary reveals limited information on acquisitions and divestitures. However, two instances are mentioned. On page 96, there is a mention of acquiring medicines or drug candidates, indicating potential future acquisitions. Regarding divestitures, it is unclear if the transfer of BEONE from BMS to the company on page 56 constitutes a divestiture or a supply agreement. Based on the financial summary, it is clear that the company has a history of paying out dividends to its shareholders. This suggests that the company has generated sufficient profits to distribute a portion of them back to its investors through dividend payments. Concerns about inventory buildup and supply chain disruption are evident in several areas. Inventory purchases have increased significantly, with raw materials and work-in-process inventory also on the rise. Purchase commitments are high at $175.1 million, posing a risk to cash flow. Furthermore, theft of inventory could impact patient safety and reputation. Supply chain disruptions are also a concern, driven by binding purchase obligations from Amgen and potential delays in receiving regulatory approvals for manufacturing facilities. Manufacturers may struggle to meet demand due to shortages of qualified personnel or raw materials. Cybersecurity threats and vendor issues could further exacerbate supply chain disruption. Climate change may also impair the availability and cost of certain products, commodities, and energy. That concludes the financial summary for BEONE Medicines Ltd. Feel free to comment below, and I will be happy to answer them when possible.